Today we're going to follow the secret life of an inventory item. From the moment it's made or bought to the day it's sold, its value is actually governed by a pretty strict set of rules called International Accounting Standard 2, or IAS 2. So let's trace its journey, from the factory floor all the way to the final financial statements. So when you look at a company's balance sheet and you see this huge multi-million-dollar number next to the word inventory, what are you really looking at? It seems so simple, right? But that single number is actually the end result of a fascinating story, and it's full of specific choices and judgments that can tell you a whole lot about the health of that business. Okay, first things first, what exactly is inventory according to the rulebook? Well, IAS 2 breaks it down into three main buckets. Think of it like this. You've got the finished goods sitting on the shelf, ready to go. Then you have the work in progress, the stuff that's still being built on the factory floor. And finally, you have the raw materials just waiting to be used. All three of those, that's inventory.
All right, so our item officially exists. Now, the first really critical step is to give it a value, a cost, on the company's books. This is where its financial journey begins, and you better believe the rules are super specific about what gets to be included. Now, the core principle here isn't just about the price tag. IAS 2 is very clear. The cost has to include everything it took to get that item to its present location and in its present condition. It's a much, much bigger idea than you might think.
Let's break that down a bit. The cost is really built in layers. First up, you have the costs of purchase. That's the price you paid, sure, but it's also things like import duties or taxes you can't get back. Then, if you're making the item, you add costs of conversion. We're talking factory worker wages and a fair share of the factory's overhead. And finally, you might add other direct costs, maybe something like the cost of designing a custom product for a specific client.
But, and this is just as important, let's talk about what you can't include. IAS 2 says no way to adding things like abnormal amounts of wasted material or the cost of storing the finished product. General office admin costs? Nope. The cost of actually selling the product? Also nope. Those are treated as expenses for the period. They don't get added to the value of the inventory itself.
Okay, now this is where it gets a little tricky. Let's say a company has thousands of identical items, but they were all bought at slightly different prices. How in the world do you know the cost of the specific one you just sold?
Imagine this. You've got a box with 100 identical chocolate bars. The first 50 cost you $1 each to make. But then, a week later, cocoa prices shot up and the next 50 cost you $1.20 each. You sell one bar. Which one was it? The $1 one or the $1.20 one? It really matters when you go to calculate your profit.
Since you literally can't tell them apart, IAS 2 gives you two main ways to handle this. The first is FIFO, which stands for first in, first out. This just assumes you sold the oldest chocolate bar first. The first one in is the first one out. The second method is weighted average, where you just kind of blend it all together and calculate the average cost of all the bars you have, and then use that average for every sale.
And believe me, this choice has a direct impact on the numbers. If you use FIFO, the cost of the bar you sold is lower, which means the more expensive bars are left in your inventory. With the weighted average method, all those costs are just smoothed out. This isn't some minor accounting detail. It directly changes a company's reported profit and the value of the assets on its balance sheet.
Okay, so our item has a cost, it's sitting on the books. But what happens while it's on the shelf? What if its value in the real world drops? The journey's not over yet. Now we have to compare its cost to reality.
And this brings us to probably the single most important rule in all of inventory accounting, and it's stated right there in the standard. Inventory has to be valued at the lower of its original cost and what's called its net realizable value. This is a rule of prudence. It basically means you can't pretend your assets are worth more than they really are.
So what is this net realizable value, or NRV? It sounds complicated, but it's pretty simple. It's the price you expect to sell the item for, minus any costs you still have to pay to finish it and actually make the sale. Things like shipping or sales commissions. In other words, it's what you realistically expect to put in your pocket.
Now, it's really important not to confuse NRV with another term you might hear, fair value. The standard makes this distinction clear. NRV is specific to the company. It's what they think they can get for it. Fair value is a broader market idea. It's the price that anybody in the market would agree on. They can be different numbers, and often are.
So when would a company actually have to do this? Well, it happens all the time. Maybe the inventory gets damaged, or it becomes obsolete. Think about last year's smartphone model after the new one comes out. Or maybe selling prices for that kind of product have just fallen across the board. Any of these things can trigger what's called a write-down, forcing the company to reduce the inventory's value on its books.
And this brings us to the final chapter of our item's journey. Sooner or later, it has to leave the balance sheet. Let's take a look at how that happens and what a company has to tell everybody about its inventory.
There are really two main ways the story can end. The happy ending, of course, is that the item gets sold. When that happens, its value moves from being an asset on the balance sheet to an expense on the income statement, and we usually call that cost of sales. The other ending is when its value is lost, and that write-down to NRV, that also gets recognized as an expense.
And finally, to make all of this transparent, companies have to disclose some key information. They need to tell you which cost formula they used. Was it FIFO or weighted average? They have to show the total value of their inventory, how much was expensed as cost of sales, and the size of any write-downs. These little details give investors the clues they need to really understand the story behind the numbers.
So the crucial point in all of this is that the one inventory number on a balance sheet, it's telling a story. It reflects the choices management made about costing and their judgments about what they can sell things for in the future. It's really a window into how well a company is managing its products, how much demand there is, and its overall financial health.
And that leaves us with a final question. Now that you understand the whole journey of an inventory item, what would a sudden, massive write-down tell you about a company? Is it just a sign of a temporary problem, or could it be a serious warning signal about its future health? Something to think about the next time you're looking at a financial report.